This LOS is distinguished between a finance lease and an operating lease from the perspectives of the lessor and the lessee. Leases, finance or capital leases versus operating leases. There are two main classifications of leases: finance leases or capital leases and operating leases. The economic substance of a finance or capital lease is very different from an operating lease, as are the implications of each for the financial statements for the lessee and the lessor. In substance, a finance capital lease is equivalent to the purchase of some asset, leased to own, by the buyer, who is the lessee, that is directly financed by the seller, the lessor. An operating lease is an agreement allowing the lessee to use some asset for a period of time, essentially a rental. So examples of situations that would normally lead to a lease being classified as a finance lease include the following. 1. The lease transfers ownership of the asset to the lessee by the end of the lease term. 2. The lessee has the option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable for it to be reasonably certain at the inception of the lease that the option would be exercised. The lease term is for the major part of the economic life of the asset. At the inception of the lease, the present value of the minimum lease payments amounts to at least substantially all of the fair value of the leased asset. And finally, the leased assets are of such a specialized nature that only the lessee can use them without major modification. So looking at finance or capital leases versus operating leases under U.S. GAAP, ownership of the leased asset transfers to the lessee at the end of the lease. That would be considered to be a finance lease. The lease contains an option for the lessee to purchase the leased asset cheaply, bargain purchase option. The lease term is 75% or more of the useful life of the leased asset. So under IFRS, they're talking about a significant portion. Under US GAAP, it's spelled out as 75% or more of the useful life. And also the present value of the lease payments is 90% or more of the fair value of the leased asset. So again, they're giving a specific percentage with regards to the present value of the lease payments. So we've seen this chart before on an LOS with regards to leases. Just look at it again quickly. The finance lease versus the operating leases. So we have to look at the lease agreement and its substance over form in this case. So again, is there a transfer ownership? If yes, it's a finance lease. Is there a bargain purchase option? If yes, it's a finance lease. Is the lease for a term for the major part of the economic life? If yes, it's the finance lease. Under US GAAP, 75%. Is the present value of payments substantially all of the fair value? Yes. Then it's a finance lease. Again, under US GAAP, that number is 90%. If the answer to all of those is no, then it's an operating lease. So continuing with finance or capital leases versus operating leases and some more information with regards to US GAAP. US GAAP makes a further distinction in defining two types of non-operating leases. One is a direct financing lease, and two is a sales type lease from the lessor's perspective. A direct financing lease results when the present value of lease payments, and thus the amount recorded as lease receivable, equals the carrying amount of the leased asset. Because there is no profit on the asset itself, the lessor is essentially providing financing to the lessee, and the revenues earned by the lessor are financing in nature, i.e. the interest revenue. If, however, the present value of lease payments, and thus the amount recorded as a lease receivable, exceeds the carrying value of the leased asset, the lease is treated as a sale. When a company enters into a sales type lease, a lease agreement where the present value of lease payments is greater than the value of the leased asset to the lessor, it will show a profit on the transaction in the year of inception and interest revenue over the life of the lease. So here's a practice question to check our understanding. Assume US GAAP applies unless otherwise noted. On 1st of January 2008, a company enters into a lease agreement to lease a piece of machinery as the lessor with the following terms. Annual lease payment due on 31st December, $50,000. Lease term is for 5 years. Estimated useful life of the machine is 6 years. Estimated salvage value of the machine is 0. Carrying value, cost of the leased asset is $160,000. Implied interest rate on the lease is 8%. and the firm is reasonably assured of the collection of these lease payments. Which of the following best describes the classification of the lease on the company's financial statements for 2008? An operating lease, a sales type lease, or a direct financing lease? Okay, this is a nice question with regards to leases, and it's under US GAAP, of course. So the first thing we have to see, check if it's an operating lease. No, it's not an operating lease just due to the lease term. 5 out of 6 years is 83%, which is greater than the 75% under US GAAP. So that criteria alone makes it some type of finance lease, okay? Next, we have to see, operating lease is out. Now we have to see, is it a sales type lease or a direct financing lease? So we have to do the present value calculation. So we're going to bring up our calculator here. Check that the periods per year is set to 1. And so lease has a 0 future value. The payments is $50,000 per year. So $50,000 is my payment. The IY, the interest rate is 8%, 8 IY, and the lease is for 5 years. So 5N, and we're going to compute the present value, $199,635. So we can see $199,635 present value of the lease payments is more than the carrying value cost of the leased asset. So that's a sales type lease, and a profit will be recognized. Okay, so you can see it's a sales type lease. The lease covers more than 75%, and the present value of the lease payments $199,635. The firm must have acquired or manufactured the asset if it is recorded at less than the present value of the lease payments. Okay, I just want to finish this LOS with one last slide. And again, I just want to show the importance of reading the text, because the sales type lease is covered in one of the examples. And in the past, I've seen candidates have kind of overlooked the part of the sales type lease. They understand the difference between a finance lease or a operating lease, but when it got into the sales type lease, they've kind of overlooked it. So again, it's the importance of looking at the examples in the text, the blue boxes, because they're the foundation for questions, as are the end of chapter readings and their solutions, okay? So this is a hypothetical company. They own a piece of machinery. They own it, so they're entering into an agreement to lease the machinery. And the lease contract requires 4 annual payments of $28,679, starting on January 1st, year 1. The present value of the lease payments is $100,000, and the fair value of the equipment is $90,000, okay? And the useful life of the machinery is 4 years, and its salvage value is 0. So we can see the first of all, is the lease a direct financing lease or sales type lease? And what is the income related to the lease in year 1? So it is a sales type lease because the present value of the payments is more than the carrying value. The present value of the payments is $100,000, and that's more than the $90,000, okay? And so that's the difference between the present value of lease payments and the carrying amount of the leased asset. And that is recorded as profit on the sale of the leased equipment in year 1. So you would have a €10,000 profit on the sale of the leased equipment. In year 2, you would have, in terms of from the lessor's point of view, it's a finance lease. You'd have your interest income on the income statement. And that's the last slide for this LOS. Thank you.